Okay, so good morning, everybody, and thank you for the organizer for inviting me to this very nice conference. It's my first time in Toronto, and yesterday was my birthday, so very happy to be here. For those who doesn't know me, I am Paola Pederzoli from the University of Houston, and today I'm going to present you a paper, a joint paper with Mirela Sandulescu, who is in the audience from the University of Michigan. So there is a slight modification of the title from the program because we wanted to be more we decided to be more specific in what we do. So I'm going to present you the CAPM on nonlinearities evidence from in-the-money options trading. So we all know that the bid-ask spread frictions in the option market are very, very big. So to compare, while in the stock market, the bid-ask spread is generally low, much lower than 1% of the option of the stock price, in the option market, the bid-ask spread is very high and can be as high as 30–40% of the option price. And so it's a very important friction that needs to be better understood. And while previous research focused on studying the bid-ask spread and the origins of bid-ask spread as a compensation for the market maker risks of the inventory risk, the hedging risk, the risks for providing liquidity. So in this work, we are going to study the problem, so the bid-ask spread frictions from a different angle. So the question we are after is what are the implications of the bid-ask spread on the pricing of options in the sense of on an SDF that prices options, and here we have in mind the SPX option market, so the market for index option, and the optimal option trading. And on these two main topics, option pricing and option trading, I would like to highlight two very important open questions that we have in the option market on which our paper is going to contribute and shed more light. So the first one is about the SPX option pricing, and as the previous paper showed, so we know that out-of-the-money put options are very difficult to price. The prices are, despite the high volumes that we have in out-of-the-money put options, which are crash insurances, the prices are too high, or equivalently the returns are very low, and they are difficult to rationalize. Indeed, they imply very high crash risk premium. And the second open question is that because of these high volumes and option pricing in out-of-the-money put option, the literature mainly focused on understanding the economic content of out-of-the-money SPX put option trading. But if instead of looking at the trading volumes in terms of contracts, we looked at the trading volume in terms of money, then we find that there are other, I'm going to show you some nice pictures, that there are other moneyness categories of options that are very highly traded, and they have been overlooked in the literature. And these are in-the-money options in the SPX 500. So the goal of this paper is to study the connection between the option trading, the bid-ask spread frictions, and the risk premia in the option market. And more specifically, what do we do to understand better this connection is that we implement and study the minimum variance SDF in the SPX option market, and we put ourselves in a complete market setting with the bid-ask spread frictions. And in this way, we use this methodology because this methodology is very flexible. So the first very nice feature of the methodology, the first nice feature of the methodology is that it conveys a model-free pricing of all options categories. So because we know that some option categories are very difficult to price, with this methodology we are going to have a very nice way to price in a model-free way all the option categories. And the second very nice feature of this methodology is that we have the duality representation. So we have that the minimum variance SDF provide bounds on the maximal Sharpe ratio in the economy. Okay, so this minimum variance SDF is going to be a portfolio of options. And this is going to make more direct and more easy the comparison with the portfolio that is held by the investors. And what do we find? Well, the first result is that we find that including transaction costs, so estimating the minimum variance SDF with bid-ask spread friction, this is essential in order to obtain an SDF which has low out-of-sample pricing errors. So out of sample, when we constrain the SDF to include frictions, then we can price all the options category. This is not true if we don't include friction in the methodology. And the second very interesting result is that this minimum variance SDF is going to entail large negative positions in the deep in the money index SPX options. This is why the title, the CAPM on non-linearities, because this reminds a lot about a CAPM style SDF. So the CAPM is a constant, which is the risk-free rate minus the market, so a negativity on the market. And if we estimate in a model-free way an SDF that prices options, we have a negative position, a deep negative position in deep in the money call options. So then, when we compare with the portfolio that is held by investor, we find that when we construct the weights in terms of dollars, we find that customers entails also large negative position in SPX in the money call option. So then, the final question is like, it means that this option category that has been overlooked in the literature contains economic information that was not previously investigated. And we conclude by showing that indeed SPX in the money call option returns, they explain the cross-section of individual equity option returns. So then we look at the cross-section in addition to what is explained by the market skewness and other known factors that we know explain option returns. Okay, so the methodology that we are using to investigate the problem is the minimum variance SDF, which includes bid-ask spread frictions. So let me first review briefly like the minimum variance SDF of Hansen-Jagannathan without frictions. So the setting, we are in an incomplete market setting. M is the SDF that price gross returns. So in this methodology, we always use gross returns. And no arbitrage implies that the SDF can correctly price all returns. So we have this Euler equation here. And because we are in an incomplete market setting, then the set of SDFs that have finite variance and that are positive and that correctly price the returns is infinite. So then the methodology of Hansen and Jagannathan is to pick one out of these SDFs, the one that can achieve the minimum variance. And this problem has a very nice duality interpretation in terms of a portfolio of returns. So what is happening when we include transaction costs into the methodology? So here we follow the approach of Latimer, and we construct bid and ask returns. So in the methodology of Hansen and Jagannathan, we have only one return because the short position is just minus the long position. But here, if we include the transaction cost, we don't have any more one return, but for every asset, we have two returns. The return of a long position, which is the position in which you buy at the ask and you sell at the bid, and the gross return of a short position in which you sell at the bid and then you buy back at the ask. So what is happening in this case? So now what is an SDF in this setting? So now an SDF is still a random variable with finite variance and positive, but now the pricing restrictions becomes disequality. So we don't have anymore a perfect pricing, but we have a pricing with errors, and where the errors come from the bid-ask spread frictions. So the idea is that in the presence of friction, the constraint SDF, we call it constrained because it's constrained by frictions, is going to yield the pricing errors. And basically it's going to be to price the bid and the ask returns within the bid-ask spread. So just for where these inequalities come from. So if we have an SDF that is correctly pricing at the mid, then this SDF is going to price. So the bid price of tomorrow discounted today has to be less than the ask price. So it has to price within the bid-ask spread. So it's important that we don't require that our stochastic discount factor prices the mid, because the mid price is a price that does not exist. So it's actually less restrictive, the SDF with frictions, than the SDF without frictions. So in this case, again, we have an infinite amount of SDFs, so we pick the minimum variance one. And now the extension of the Hansen-Jagannathan result also hold here, because the minimum variance SDF here is still a portfolio of returns, but now we don't have one return, because but we have two returns. So we have basically two portfolios, the portfolio of the ask position and the portfolio of the bid position. And what is the idea here? So the idea is that we are kind of making a shrinkage of the SDF, because these pricing restrictions are going to force some of the weight to be zero, exactly of those assets that have very high pricing errors. So in these methodologies, it's also very, very interesting to look at the bound, okay? So at the bound, at the Hansen-Jagannathan bound on the maximal Sharpe ratio of the economy. So when we don't have friction, so this is the classic bounds of the Hansen-Jagannathan minimum variance SDF. When we have friction, so we also extend these bounds when we have frictions. What is going to happen here? So we still have that the variance of the minimum variance SDF is bound, bounds the maximum Sharpe ratio of the economy, but now we have two bounds, because now we have the maximum Sharpe ratio of the long position and the maximum Sharpe ratio of the short positions. Okay, so let's now go into the estimation. So this was the theory that we used. So then we are going to estimate the minimum variance SDF on option returns. So which returns are we using? So we are going to use bid and ask prices of all SPX option on the options on the S&P 500 from option metrics. The time span is between, from the beginning until the end of 2020. And for every option, we construct daily mid, ask, and bid returns. So here we have the simple returns, and here I presented also the gross returns. And then we form portfolios, okay, according to the moneyness of the options. And in particular, we form 14 portfolios, 7 for calls and 7 for puts. And we denote C1 according to their deltas. So the idea is that C1 contains the most out-of-the-money call options. C4 are the at-the-money call options. C7, this is a very important bucket in our analysis, is going to contain the most in-the-money call options. And the same we have for P1 from P1 to P7. So P1 is going to contain the most out-of-the-money options, those that are very difficult to price, P4 at the money, and P7 the most in-the-money put options. Inside every bucket, the options of the individual, the returns of the individual options are equally weighted. This is not we also do a robustness check for value weighted, is not going to affect the results. Okay, so before going into the result of the estimations, so some summary statistics on the bid-ask spread of these option categories, and also the returns at the mid, at the ask, and at the bid. So as I already anticipated, so the bid-ask spread is very high in the option market, can be as high as 40% of the price. And they are clearly decreasing in the moneyness. So the in-the-money options have a less bid-ask spread, lower bid-ask spread compared to the price. Also, we can find back some results that are known in the literature, so that we find that the mid-call option returns are decreasing from C2 to C7, okay, and this basically shows the monotonicity of the SDF. So the SDF is decreasing in market returns. So when market returns are very high, so this is like a very good state of the world. So then options that pay well in these states, which are like the out-of-the-money options, they have a very high return, because these are very risky instruments. An exception is here the C1, and here shows like that the pricing kernel is actually U-shaped. So this is just to show that we know that inside the option pricing there are some features, some non-linearities of the SDF, and our methodology, because it's model free, is going to incorporate of them, and we are going to price all this category of options. For the put option, it's very similar. So the summary statistics. A thing to note that the bid-ask spread is very high, and when we transform the mid-return into ask and bid, we have a huge decline in a return. And this is why we compute the methodology by considering the full bid-ask spread, but also we are going to decrease the bid-ask spread by more and more percentage in order to decrease this very huge friction. Okay, so this graph is showing the result, so the optimal SDF in terms, so the SDF, as I said, is a portfolio of option returns. So we call it unconstrained, so the SDF that with no transaction costs, so that basically perfectly price the mid. And then we call it constrained, the SDF that prices within the bid-ask spread all option market. And what is very interesting is that we see, so first of all, we see that here this SDF is not very well behaved. So we see that it touches the zero, okay, very often, while this SDF, when we constrain, is much more well behaved, and as expected, it spikes in crisis. And then the other consideration is that we can see a very prominent negative weight. So you probably cannot read, but you know, this is the C7 bucket of options. So a negativity in the money call options. So this, what is this telling us? And this is also robust, as I was anticipating. So here we consider. So here we considered fully the full transaction cost, so the full bid-ask spread, but then we also decrease the bid-ask spread. So here we considered 40% of the bid-ask spread, 20% of the bid-ask spread, so it means we reduced by 80%. So there was a big reduction, because the idea is that investors don't trade options daily, they don't rebalance daily, so then they are not going to pay the full bid-ask spread every day. So here, so what we can see is that the main bucket of options that is important in this optimization is the in the money call options. And we can also see that when we are in a very low transaction cost environment, so we cut a lot the bid-ask spread, so we have also very high, you know, weights. So we can see here -10, while the more we increase the bid-ask spread, then we have that the weights are going to be more like well behaved, so less extreme. There is less leverage, you know, in the option buckets. So this is why the CAPM of non-linearities. So we wanted to price options. We want to find an SDF that prices options, and what do we find? Well, it seems that a very good pricing for this option is a CAPM style SDF. So what happens if we include the risk-free rate and the market in the optimization? So if we want to find an SDF that prices options on the market, and then also the market and the risk-free rate. And this becomes interesting because, so first of all, the market here, we use the SPY. So we have the bid and the ask, and we compute the same analysis for different levels of transaction costs. And what we find is that now the CAPM is mainly on the market. So we see that the risk-free rate is positive. So you probably don't see, but these first two buckets, one positive and the other one very negative, these are the risk-free rate and the market. And this is the CAPM. So the CAPM is A, so the constant, which is the risk-free rate, minus B, the market. And then, but we can also see that even for high levels of transaction costs in both the market and the options, we have non-zero weights in the option market. So what does it mean? Well, it means a lot of things, but first of all, it means that from this it seems that options are not redundant. Because if they were redundant, then the optimal would just be the risk-free rate and the market. But we still have some weights in the options. So, which basically is saying us that we can complete the CAPM with options, okay? And because in this way we can find that an efficient portfolio with options that is more efficient than only the market portfolio. And the other thing is that this bucket, the biggest one here, is always, you don't see, but this is the C7, is the in-the-money call option bucket. And now we have a kind of an edging. Until what time I have? Ah, yes, of course. This. Yes. So my understanding is that the bid price is an ask price. So how do you change that ask price? So yes, of course, this is an exercise. So we start from the mid, and then instead of adding the full bid-ask spread, okay, so then we simply add 40% of that or 5% of that. So this is not the real one. Not the real. No. No, but the real one set what is the 100%, right? And that can be different every day. But when you do this thing, you use the actual bid price and ask price to do that? Yes. Rather than this hypothetical situation? Yes, so you take the bid, so you take the bid and the ask, and this is 100% of the bid-ask spread. And then you can take, you can shrink it basically. Then of course you have an hypothetical bid and ask that is not exactly what is, what is there, but. So when you say 5% cost 40%, is that the original one? Yes. Shrink it to only 40%? Yes. So this is actually better than real one. This is actually better? In terms of the bid-ask spread is smaller than what the actual one. Yes, much smaller. So the point here is that I even if I cut the bid-ask spread by 60%, 80%, and I still have this, this result. But this is, even if it seems a huge cut of the bid-ask spread, we know that, the bid-ask spread actually paid by investor is not the quoted one at the end of the day. So we do have a price improvement mechanisms, and there are papers showing that is much lower than that. And on top of that, here the bid-ask spread is considered daily, as if, and you get the full, bid-ask spread only if you buy and sell tomorrow. Otherwise, if you buy and sell, in a week or something, then you have one bid-ask spread, and this has to be divided by the number of days you hold your investment. Okay, so this is where this cutting of the bid-ask spread come from. Okay. Okay, so then, of course, it's important. This is an SDF. Okay, so this is basically the SDFs that prices options. So an important question is how these SDFs perform out of sample. How can they price options out of sample? And here we, in order to in order to construct an out-of-sample exercise. So we estimate, we follow Jagannathan and Ma. We estimate the SDF, so the optimal portfolio weights every year. And then we price we see how our SDF performs in the pricing of the options next year. And we investigate two questions. So the first one is that we compare the out-of-sample pricing errors of the constrained and unconstrained SDF, okay? So without frictions and with frictions, how do they price the bid, and the ask returns? And for us, the pricing errors, so is how distance is from one, okay, the pricing of, the pricing of the returns. And then the second question, and this connects to my motivation, so how these SDFs price the bid and the ask returns out of sample within the bid-ask spread in different moneyness categories. This is satisfied mechanically in sample, because we look for an SDF that do price, but then the big question is how is the performance out of sample of these SDFs. So here I present the results for calls. So here M is our unconstrained SDF, so no friction, M tilde with friction. And here I present where there is written diff is the difference in the pricing errors of the unconstrained versus the constrained SDF. And you see that all over the board, we find that the pricing error implied by the unconstrained SDF is much, much bigger. Okay, so it's interesting because in sample, it's perfect. The Euler disequality is an equality in sample, but then out of sample, a complete disaster. If we allow for frictions, then we find that the pricing error is much lower than the unconstrained. Only one small exception, but otherwise we all have that is positive. In bold, I show here in bold when the SDF price the bid and the ask out of sample within transaction costs. And here, okay, so if the disequalities are contemporaneously satisfied for the bid and for the ask. And here, it's interesting that the unconstrained SDF does not price the bid and the ask within the bid-ask spread. Okay, so the errors are too big, basically. They go out of the bid-ask spread, while the constrained SDF do price within the bid-ask spread. And this is true for all option category. And if I go to the put, so this is for puts, you see, P1, P7. P1 are the categories of option that are very difficult to price. And here, basically, we have a very simple model-free methodology that is naturally pricing all options category within the bid-ask spread. Yes? Yes, so you have in mind, if I understood correctly, you have in mind that this SDF is basically one factor. Yeah. As a factor, yeah, and then you can have the alpha, yes. Yeah, thank you. Okay, so far I've shown you that this minimum variance SDF that prices options. When we include frictions, we find an SDF CAPM style, so where in the money deep in the money call options are very important and negative in the SDF, and also the pricing performance out of sample is very good. So then the question is, we know that the previous literature mainly focused on out of the money put options trading and the economic content of that options. So what about this option category that seems to have an important economic information that was never investigated? So the first question is, do investors trade these options? So in order to answer to this, we construct the daily positions of investors in every option category, but not by looking at the contracts, but by looking at the dollar weights, which is actually the standard way in which you construct a portfolio of assets and to calculate the weights that investors have in those assets. So to distinguish between who are investors and who are market makers or intermediaries, we use the order flow data from the SIBO open close databases that basically contains all the buys and sell orders breakdown by investor category. And for us, public investors are the customers, because firms and market makers are clearing members, and market makers, they are intermediaries. So because the option market is in zero net supply, the position of customers in aggregate is the opposite of the position of intermediaries. And we can cumulate. So how do we find these weights? So because options, are born and die, so then we can track, we can cumulate the number of buys minus the number of sells, and we can get the positions of investors, of customers in all options. And then and this is how we get the inventory. And then by multiplying the inventory by the price of the option, we get the total dollar exposure of the investors in each option category. And then we can compute the weights. So the proportion, so how much money investors have in every option category compared to the full investment. And here, what we find is very novel. So it's very, and I think it's very interesting. So if we look at a portfolio which is constructed contract weighted, and this is the standard way to do that, so then we see that this very big weight is the moneyness category P1 out of the money put options. So here we have that investors are long put options, and this is the most important weight. But if we look at the dollar weighted portfolio, so then what we find is that we still find that there are long put options, but we also find that they are short in the money call options and also a little bit in the money put options. But here you see it's very different, the weight, if you consider dollar weighted or contract weighted for the in the money call options. So investors do trade in these category of options that it seems to be very important for pricing, but has never been investigated. So then the next natural question is, what drives in the money options trading, and what is the economic information that is embedded into this category of options? So first we confirm, according also to our previous result, that trading in the money call options is linked to illiquidity. And what we do is that we take the innovations, so the R1 innovations in trading, so in the net demand in C7, then we also do in the put in the 8, 11, and 14 buckets. So these are put options, and then here are call options. And we regress on the R1 innovation of the effective spread. So basically effective spread, because we really go every day in the high frequency data to check the actual spread paid by investors for every trade, and then we compute simply the innovations. And what we find is that is really the link, the higher link we have with the moneyness category of in the money call options. So when for the T statistic, for the significance, and also for the R square. So when illiquidity is high, investors trade more in the money call options. Okay, so this is basically consistent with our theory, with our econometric analysis that I showed you before. And then we are also working on data on short selling, because given the nice complementarity that we have seen between the market and in the money call options in the SDF, we expect that in the money call options trading is also linked with short selling frictions, so that there is that investors do use this complementarity between market and in the money call options. And to conclude, we look what is the explanatory power of in the money call options returns for explaining the cross section of individual options return. Okay, because if they are in the SDF, they should have some explanatory power for the cross-section of individual option return. And so here we have to be careful because, of course, the correlation between in-the-money call option returns and the market is very high. So it's going to be difficult to pin down exactly the additional contribution of the returns of in-the-money call option compared to the market. So first, so the factor is lambda is a C7, but before we don't use the raw return, but first we orthogonalize the return with respect to the market, so we can test if the residual has some explanatory power for option returns. And we do find that the bid return of in-the-money call options orthogonalized with respect to the market, carries economic information for the cross-section of option return. And this is mainly true after, the financial crisis. And we also control, of course, for the market, but then also for volatility, skewness, and in particular for the bid-ask spread. Okay, so so there is an economic information in addition to the economic information that is carried by the bid-ask and the market. Okay, so to conclude, in this paper, we implemented a model-free framework in order to study option returns by incorporating financial frictions relevant to this market, which is the bid-ask spread. And the minimum variance SDF that is consistent with the bid-ask spread is a portfolio that is short deep in the money call options. So this is why we call the CAPM of non-linearities, because this is a CAPM style SDF. And we find that incorporating transaction cost is essential in order to have an out-of-sample pricing performance of the SDF. And then when we look at what investors do at their portfolio, we do find that public customers construct trading strategy using a big position in the money call options. And finally, we showed that this category of options in the money SPX call options, which have been overlooked in the literature, contain relevant economic information for the pricing of the cross-section of individual option return, in addition to the market and bid-ask spread factor. Thank you.